Uh-oh. So on Wednesday, January 9th, 2019, earlier this week, well, last week since we're doing this on Sunday, but only a few days ago, Fitch issued a warning to the U.S. government. Fitch warns, this is a Washington Post article. I will attach a link to it, and it will be in the Wall Street for Main Street. It will be in the information section of this live stream show after it's over. So Fitch warns an extended shutdown could hurt the U.S. credit rating. As the partial U.S. government shutdown dragged into its 19th day, it's obviously more than 19 days now, but this was written on Wednesday, Fitch Ratings warned Wednesday that an extended shutdown might damage the country's AAA credit rating if lawmakers are unable to pass a budget or manage the debt ceiling. While President Trump spars with Democratic leaders over $5.7 billion for a border wall and funding for 9 government agencies, hundreds of thousands of workers are caught up in the shutdown, furloughed, or working without being paid, and much of the federal government is paralyzed. I don't know if much of the federal government is paralyzed. I mean, a lot of the budget is still being spent. A lot of the spending is already baked in for 5 years from now. So it's considered, I think it's non-essential personnel is not working now. Now, what's the government's definition of non-essential and your and my definition of non-essential is probably pretty different. Anyways, let me keep on reading. So the day after Trump took his fight for the wall to primetime TV on Tuesday, Fitch's head of global sovereign ratings, James McCormick, said that if the shutdown keeps lawmakers from being able to address the debt ceiling in early March, the inefficiency and ripple effects might do lasting damage to the country's credit. Quote, I think people are looking at the CBO, Congressional Budget Office, numbers. If people take the time to look at that, you can see debt levels moving higher. You can see the interest burden in the U.S. government moving decidedly higher over the next decade, end quote, McCormick said in an interview with CNBC's Squawk Box Europe. Quote, there needs to be some kind of fiscal adjustment to offset that, or the deficit itself moves higher, and you're essentially borrowing money to pay interest on the debt. So there is a meaningful fiscal deterioration there going on in the U.S., end quote. So if the shutdown is still in effect by March 1st, quote, and the debt ceiling becomes a problem several months later, we may need to start thinking about the policy framework, the inability to pass a budget, and whether all of that is consistent, end quote, with a AAA credit rating, McCormick said at a later event in London, according to CNBC. Still quoting McCormick on another quote, from a rating point of view, it is the debt ceiling that is problematic, end quote. And so a downgrade in the U.S. credit rating would make borrowing more costly for companies and American households, according to Bill Foster, Vice President and Senior Credit Officer at Moody's, one of the big 3 credit rating agencies, along with Fitch and Standard & Poor's. And quote, beginning quote again from this guy, the U.S. credit rating is the basis or benchmark for so many other lines of credit. If there was a change in the credit rating, you'd expect the cost of borrowing to go up, and that would cascade through the economy, end quote. Let me keep skimming here. I did read this article. Let me see anything here that's... I think there's a couple more things here. So the only time the country's credit rating has been downgraded was in 2011 when Standard & Poor's dropped the U.S. rating after the government raised the debt ceiling to allow trillions in additional spending. Still skimming through here. Okay, so I know what I want to talk about next. You can read the rest of the article after I put the link in the information section. But the other thing I wanted to talk about, so 2011, and this is a warning for Fitch. So I said uh-oh at the beginning of this short little live stream show, because not only is it bad for the U.S. federal government for their borrowing, it means they're going to pay higher interest costs, could be many billions of dollars more in interest expense per year if they're downgraded, but the uh-oh is also for Fitch, because there is historical precedent in just the last basically 6 to 8 years that of all the major rating agencies and also independent agencies, that if you downgrade governments, whether it's the U.S. government, France, or Germany, you are risking retaliation. And so I wanted to bring this up for my listeners who are either new to the podcast or are not as familiar with financial markets. The curious case of Egan Jones. So for those of you guys who are not familiar, Egan Jones was founded in 1985 by this guy named Sean Egan. He's a very well-respected researcher. It's an independent research firm. They mostly do insurance agency ratings, and I believe they have like a 94% accuracy from independent audits. And so they used to rate government bonds and government credit, but in 2011, after they downgraded the US's credit rating, because remember I read in the article that S&P downgraded the US. Well, Egan Jones also downgraded the US. I have the Zero Hedge article. I had to look for it. So the original Egan Jones downgrade, US was downgraded from AAA down to AA plus on July 18th, 2011. And basically, once Egan Jones did this, a whole shitstorm came out. Okay? An enormous shitstorm came out for Egan Jones. And a bunch of crazy things started happening to them because they're not part of the three major ratings agencies, this status quo, command and control, or what I would probably label it more accurately as corruption and control system. For the three major rating agencies, that's S&P, Standard & Poor's, Moody's, and Fitch. So Egan Jones was trying to be more honest and more transparent with their ratings on government bonds starting in 2011, and they paid a very big price for it within like about a 2-year span. So I'm going to read the headline articles here for Egan Jones. So they downgraded the U.S. first in 2011, and trouble really started to follow them immediately after that. So basically, the SEC started looking into them. The Securities and Exchange Commission started immediately looking into them very soon after. And they were investigated almost immediately within less than 6 months by the Securities and Exchange Commission. And the Securities and Exchange Commission has also gone after the other rating agencies, Fitch and Moody's, as well. S&P, Fitch, and Moody's too, when they didn't like the downgrades for either certain products that Wall Street issued, or Wall Street banks, or insurance companies, or other government debt. So Egan Jones, in that time span from 2011 through basically the end of 2012, they were also downgrading French debt and German debt. And basically all these governments colluded and decided that Egan Jones wasn't going to be allowed to be in the party. Egan Jones downgraded the U.S. again. I have this article from Silver Doctors on September 14th of 2012. They downgraded the U.S. from AA to AA minus. So they further downgraded them even further. And basically by 2013, it was January 22nd, 2013 in the headlines, Egan Jones had basically, they said it was only for 18 months, but it's basically permanent, because if I went to the Egan Jones website before as some background research before I turned on the live stream, and they don't say anywhere on their website that they rate government bonds anymore. So they've basically been threatened and fined and sued to the point where they cannot honestly rate government bonds, so they are totally out of that business. But on January 22nd, 2013, I have a CBS News story and headline, and all these stories that I'm looking up, you'll get to see in the information section, description section of the video after it's done. It says Egan Jones banned from rating governments. So the Securities and Exchange Commission is barring, B-A-R-R, not borrowing, Egan Jones ratings from rating governments and issuers of mortgages and other types of bonds for at least 18 months as a recognized ratings agency. The SEC said Tuesday that the independent credit rating firm agreed to the measure to settle charges that have made false statements when applying to become a nationally recognized statistical rating. So basically, because they downgraded the U.S. debt, the regulators, the federal government people started looking into any little thing that they had not done correctly in the past, whether it was crossing T's or dotting I's. And if you go back through the stories that came out from the mainstream financial media like New York Times, Dealbook, and others, they were saying basically most of them are overwhelmingly anti-Egan Jones and saying they got what they deserved it. And I think, a lot of those are so biased, and they're basically plants from a lot of the Wall Street banks. So I wanted to get that point across. There was one Bloomberg op-ed piece from September 30th, 2012, and I thought it was interesting. William D. Cohan, C-O-H-A-N, and he said that the SEC sued the one rating firm not on Wall Street's take or payroll that could actually, have somewhat of an honest opinion. So prior to basically downgrading the U.S. government credit rating agency, and the U.S. government credit rating, and downgrading France and downgrading Germany within like a 2-year span, Egan Jones was not in any trouble. And that's when the trouble for them started. And the credit ratings agencies, the three major ones, they don't do their job. They get paid fees. They're basically Wall Street's lapdogs. And they get paid to rubber stamp stuff. I've talked about this, remember, in the last month or two. I talked about how for basically the last 10 years that no lessons were learned with the debt crisis, and that the credit ratings agencies have rubber stamped corporations to continue to borrow tens of billions of dollars more in debt. And their credit ratings for most of these corporations, publicly traded ones, large ones, were never downgraded. They were not accurately downgraded. Hey guys, the other reason I'm also live streaming is with this live stream show, I've also just crossed over the 4 million YouTube channel views milestone. So I've been working hard to get to that. So I wanted to just have like an impromptu little get together online, a little hangout. It's a long time coming. Without the YouTube censorship, I mean, I would have been at 4 million views years ago. I should be over 8 million views at this point. Without the censorship, I would have over 50,000 subscribers on my channel and over 8 million views. I literally see tons of YouTube channels still getting 10,000, 20,000 views per video, and I used to get that, and I don't get anything near that anymore. But yeah, I wanted to provide value for you guys with the Fitch warnings. So basically, Fitch better watch their back. Maybe they're going to get further investigations or fines. The regulators, the SEC, the Department of Justice, any little T or I that Fitch did not cross, if they actually do threaten to downgrade, they're going to have, the sword of Damocles coming down on them. And the ratings agencies, this scheme of carrot and stick that the federal governments have done, and the European governments are colluding with the American government to go after the ratings agencies to make sure that they don't get downgraded either. But this scheme of carrot and stick, where if the where if the credit ratings agencies don't downgrade, they don't get like massive investigations like IRS audits every year, and they don't have, the SEC going after them, and they don't have the Department of Justice going after them. So basically, it's kind of like a protected oligopoly, but it's a corrupt one, and it's part of a control mechanism. But if you want to research this and learn about it more, Egan Jones was railroaded. They are totally out of the government rating business for credit rating. If you go to their website, and I went to their website, they don't even mention it anymore. Like, they have news articles from when they were doing it that were actually positive about them, that were more unbiased compared to the coverage that they got from the mainstream media and mainstream financial media. But, they've just decided that to stay in business, and I'm sure they had to deal with their legal bills probably went through the roof, that for them to stay in business, they just couldn't do that anymore. And to leave it alone and get out of there. Hey, Dan. Thanks for messaging. Prasanthi girl, hey. I know your real name. You won't allow me to say it, so you can email me later. Herb Levin, honestly, I think like the ratings agencies should be shorted and should go bankrupt, but they may be bailed out. These things are a disaster. The three largest ones, if there was like honest free markets, these ratings agencies would have been sued to oblivion. But I don't think that's going to happen. I think they're part of the large command and control mechanisms. Barba Papa, you don't downgrade your master or you get suicided. Well, Egan Jones wasn't getting all this extra Wall Street money from the Wall Street investment banks to rubber stamp all these products. Egan Jones actually had a very good reputation. If you go to their website, they had a good reputation for independent ratings for insurance companies and others. And so they tried to, expand their business and get into like government credit ratings, and that backfired clearly. BVH, thank you for the super chat donation. You will have to email me and tell me some good Belgian beers. Okay, I'm looking through listener questions and comments now. This was kind of impromptu because I saw the story about the credit rating agencies. I heard on another podcast, and I'm kind of snowed in. I'm snowed in tonight, so I haven't really done anything. And there's over 6 inches around here, so everything's pretty much shut down. Actually, funny thing, I actually saw Dr. Sebastian Gorka and his family at the grocery store. The guy from Fox News. That was a random. I've seen Gordon Chang around here too. I think his daughter just moved down here like about 6 or 8 months ago. Hello, Ryan O. This is a great question. Do you think the French will succeed in creating a bank run? So with the modern day digital debt-based fractional reserve banking system we have, all these large French banks like BNP Paribas and others, all they have to do is send an email or make a phone call to the European Central Bank, and the European Central Bank can just send with a couple keystrokes reserves. So you could drain cash from the bank, but the bank would still have reserves with the computer systems. So it would just be a cash shortage, and the bank would just say that we have reserves and we just don't have the cash right now, but we have the reserves, so we're not insolvent or anything like that. So I don't think the bank run that the French are planning, the yellow vest protesters are planning, like in the past, a bank run would have been a way to check a bank, but the way things are set up now, I don't think it's gonna go down as planned. And the banks don't even really need to carry that much cash anyway. So they could just tell their customers that we're getting a shipment tomorrow or the next day of cash, and you have to come back tomorrow. Everything is digital now. They hardly even print too much money anymore. I mean, the average person doesn't even understand how the banking system works, and that's part of the problem. Like if you started talking to regular people outside of a regular bank and trying to tell them that the bank actually doesn't have most of the cash that was deposited, they have 10% or less of the total cash that was deposited there, they would think you're freaking nuts. Correct, Ryan. Yeah, US banks, yeah, they'll look at you like you're a criminal if you try to take out too much cash at once. This is correct. Yeah, if you try to take out too much cash at once, or they monitor now if you have all the different bank accounts you have, and if you try to take out too much cash in 1 month from different banks, you get flagged too. It's crazy. You put the money in there, and then they act like it's theirs. They act like it's not yours anymore. Well, they put your currency in there. It's not really money anymore, is it? Herb Levin. Good to see you, Herb. You're a regular here. Oh, you always have good posts. I enjoy them. You want to see some rating agencies try and downgrade. They'll get some visitors that are unwanted. So in the past, if you look through these articles more that I'll attach links to, the ratings agencies have been fined and investigated and threatened and audited the larger ones, and they've kind of, through this combination of carrot and stick, learned their lesson that they cannot bite the hand that feeds them. So this is why the ratings agencies are so apprehensive to actually do real downgrades. And I think if Trump wasn't president, I don't even think you would have seen a story like that, saying that like Fitch is considering a downgrade, a major ratings downgrade in March. Ain't that stripes? Can't downgrade central banks' printing presses. Well, actually, the foreign exchange rates on currency should be downgraded, but the problem is you have central banks and plunge protection teams and actual treasury departments and politicians in there who want their exchange rates manipulated. So that's one of the biggest manipulations, is currency exchange rates. They don't always work, especially for countries like Brazil, because Brazil's doesn't have massive trade surpluses. So, but they are trying to go in there and manipulate. but you have unprecedented volatility in currency exchange rates lately. And so in the past, before there was this much central bank intervention, before 2008 and all the crazy, bailouts and QE programs and negative interest rates on $9 trillion or more in debt, that a 1% move in a currency exchange rate a year, 1 or 2% was a big deal in the past, before 2008. Now, you're getting 1 or 2%, guys, in a day. Hey guys, thanks for the congratulations. I appreciate it. Okay, Michael Wilson. Hi, Jason. What do you think of the IMF warning of Great Depression? Thank you for sending me the article link. It's these warnings, guys. The Bank of International Settlements has been warning about this stuff. The globalist ones are the ones that are kind of, they're pro-China now. A lot of these guys are champagne socialists. So they went to certain universities that brainwashed them. They're hardcore Keynesians. They prefer China now to the U.S. They prefer socialism. They're champagne socialists. So they want the U.S. to go down. Michael, it really depends if the people in power are going to keep changing the rules. Because ideally, this is just speculation on my part with educated guesses and doing a lot of research, but the people in power, for the most part, they really want like a controlled devaluation of their currencies to deal with their pension fund liabilities and unfunded liabilities and debt problems. So most of these governments, the large economies and the large central banks, they want like a stagflate and lie. The problem is that a lot of people, like you see this in France and in other parts of Europe, are waking up that they can't make ends meet anymore. Their incomes haven't risen, their taxes are going up, and they don't understand that inflation is the main problem, that it's currency devaluation. So they don't understand the banking system and how money works, and that the main reason that their standard of living is being eroded is mostly due to currency devaluation. That is not showing up in the real inflation statistics. Because most of us are not getting any wage increases. If you get a promotion, I mean, most of the people on Main Street know this, that if you get a promotion, you're signing your life away. You'll have no personal life. So to get that extra money per year, that extra salary increase, that you're working an insane amount of hours, and your marriage or relationships and family life and time off and even your health, working out and eating healthy and staying in shape and stuff, that could go down the drain. Because most human beings, at least from personal experience, from myself and talking with others and seeing other people, that if you work 60 hours per week or more, and you do this for 10 years or more, or a long time, your health is going to pay an enormous price. It's very difficult to keep your health to keep yourself in good shape and very healthy and working that many hours for many years. Nick Polverano, the Fed's data dependent, in other words, S&P dependent. Yeah, so I think this goes back to they are really worried about their tax revenues, because the Luke Groman put this on his Twitter recently, that tax revenues have gone down quite a bit as Trump has done the Trump tax cuts. So the doctored U.S. government economic data is looking good. It looked good for a while because of the Trump tax cuts, but it did not help with the annual tax revenues. So Trump was promising, and you hear this from all these supply-siders, that if they do supply-side economic stimulus and the budget deficits blow out, that eventually in the long run it will really help tax revenues, but so far it has not helped tax revenues. In terms of, as an Austrian school free market economist, what had to have been done correctly and was not done is, with these tax cuts to the private sector, there should have been corresponding massive cuts in government spending, and it was not done. So at some point, the U.S. is going to pay a big price for this. Now, the Fitch credit rating agency is saying that the debt ceiling not being raised is why they would lower the credit rating, but it should be the total debt. So in the article, they didn't mention the total size of the debt for why they were going to downgrade, which is just stupid. Well, Nick, if you've saw my live stream, if you've listened to my live stream shows in the last 2 weeks, Alan Greenspan dropped a truth bomb at a speech in 2015 after he had left the Fed, and he said that over the last 10 years, probably a little bit longer than that the capital gains taxes for stocks, bonds, and real estate take up a much larger percentage of annual U.S. tax revenues. Yes, Douglas, that was in my short video a couple days ago in Jeff Gunlock's presentation. That was the slide. That took me a lot of work to do that presentation, over 3 hours. So the official U.S. government increase in budget deficit is not that 1.44 trillion number you said. Bill, Americans have to work because a lot of them try to succeed, and they don't want a handout. There's a lot of Americans out there who don't want a handout. Okay, they want to succeed on their own. It just becomes harder and harder every year to succeed on your own. There's a lot of people who don't understand that inflation and taxes are what is destroying them, though. So even if they cut back on their standard of living, that inflation and taxes, currency devaluation, and taxes going up, being layered on pretty much everything, are what is destroying their standard of living. R.R. Gunlock said that U.S. is on a suicide mission. All these major governments are on a suicide mission. No government's doing a good job. China has grown debt and credit faster than anyone else in world history in the last 10 years. China is an enormous disaster. Now it is. The best case scenario for China is what happened to Japan. Okay, meanwhile, I could go into all these details. I would suggest listening to Christopher Irons just did an interview with Carson Block of Muddy Waters Research, and he lived in China for a while. I would listen to it was like an hour 20, that interview. I would suggest going and listening to it there. The people in power have most Americans so brainwashed that it's like heads we win, tails you lose. So basically, the people in power can totally destroy the system, and then capitalism gets blamed. Meanwhile, it's stuff that's not free market, not capitalism, that's ruining things. There's no government on the planet, basically, that's doing a good job right now. 10 years ago, China... Let's put things in perspective. So, we don't know how much gold China had 10 years ago. They were buying gold. But 10 years ago, China had almost no credit bubble, almost no debt, and they had $4 trillion plus in reserves. So China had no debt, no credit bubble 10 years ago, and they've just gone crazy. China was in much better... We don't know how much gold China had 10 years ago. They obviously have more gold now. But China's economy was much more stable 10 years ago before they went out of control with this credit bubble, and they're doing massive amounts of bailouts. Lots of different types of bailouts from what my sources are telling me. And they're kicking out the best and brightest, most capable foreign businessmen and foreign businesswomen who worked very hard to assimilate into their culture, married a Chinese bride or husband to succeed there, and they're still kicking them out. Okay, guys, well, we're almost at 30 minutes, and I just wanted to talk about the Fitch downgrade, and Fitch better watch their back. The Fitch's lawyers are going to make a lot of money off this. They're going to be like the lawyers that Elon Musk is hiring. Elon Musk's lawyers are going to make a ton of money off him because he can't keep his mouth shut. So, in the new normal we're in, if you piss off the wrong people, you better have good lawyers. And that's it for today. thank you guys for helping me get over 4 million views. Unfortunately, it's just not a situation where you can earn a living making the content on YouTube anymore. So I blame mostly YouTube for all of this. YouTube is evil. Okay, guys, well, that's it for today. Thank you for getting me over 4 million views. I should have a lot more. I should have a lot more subscribers, but it is what it is. Thanks, everyone, and good night.